Welcome, everyone. Welcome to the third Q&A of 2024. I'm Ines Magda, the co-host of Made It Podcast, one of the leading entrepreneurship podcasts in Italy, and the moderator of today's event. Today's Q&A is actually going to be slightly different from the previous ones. We have invited Robert Rubinstein, a prominent social entrepreneur and the founder and CEO of Triple Bottom Line Investing Group, who will give us a lesson about all things ESG. Just to give you a bit of background about TBLI Group, they're a renowned global network dedicated to sustainable finance and investment, empowering investors to achieve financial returns while making a positive social and environmental impact through their sustainable investment advisory services, sustainable investing education and events. And they're specialized in impact investing, ESG investing, green bonds, climate finance, and responsible investment. Robert, we're very excited to have you here with us. ESG is such a buzzword at the moment, but it seems to be used without real understanding. So we're keen to understand the true meaning of impact investing and your advice on how to best manage and structure ESG investments. Just want to give a reminder to everyone, this is a interactive session. So please do not hesitate to write in your questions on the chat box, and towards the end of the session, we will leave 15 minutes to answer all your questions. So Robert, welcome, and I'll let you take it away with your presentation.
Well, thank you so much, Ines, for inviting me, and thank you, Luca, for doing this. And most important, I want to thank the grandfather of Luca for inventing the most important invention in the history of mankind, the espresso machine. Thank you. So I'm going to cover what is ESG and impact investing, and is it actually doing what it claims to be doing. So for those of you who are not familiar with us, my wife likes to say TBLI makes dreams come true, but we're not in cosmetics. Our work is mainly to change the financial system so it works for all stakeholders by educating asset owners and managers about sustainable investment. And we've been doing that for nearly 30 years. So when we're trying to convince investors about sustainability, the way that they look at the earth as a risk or an opportunity pretty much determines how they deal with everything. Is everything a risk, or is everything an opportunity, or is it a mix of things? So this is me when I used to work on oil rigs in Iran many years ago. If people believe that change is not inevitable, and this is me ringing the bell at NASDAQ. So, things can change. It's not impossible to change. We've seen it consistently. If you look at, this is where TBLI was coming from, and the people that we had to deal with, and actually many of them are still thinking like this.
I will live each day as if I were the only one that mattered.
I will do anything that I want to anyone who can stop me.
I will regard each tragedy that befalls my fellow man as an opportunity for personal progress.
I will exploit the weaker and less fortunate. I will remember that war is good for business.
And nice guys finish last.
I will invest with Wormwood Bain.
Wormwood Bain.
Wormwood Bain.
Wormwood Bain, the stock fund for socially irresponsible investors, with performance that outpaces the market year after year. At Wormwood Bain, we invest only in the smartest, meanest, most ruthless businesses in the country. Companies that underpay workers, bust unions, export jobs overseas, use third world child labor, and ignore environmental regulations, because they add more short-term dollars to the bottom line. And in the long run, we're all dead. So if your greed is bigger than your conscience, invest your money with Wormwood Bain.
Market savvy.
Socially irresponsible.
We don't give a shit.
And they're actually hiring. I think they're launching a new fund too for those in the audience that are looking for something less responsible. So if we look at what are the really big macro drivers that are pushing interest among sustainability or ESG impact. So basically, this is a book written by Lester Brown, Plan B, and he calculated if this linear growth of these countries, particularly China, what does that translate into? So his conclusion was if China would reach U.S. consumption levels by 2031 with an 8% growth, obviously it hasn't, it's gone down a bit, so it's not going to be this massive linear growth. But that would mean if they continued on that path, they would need close to 80 million barrels of oil themselves. They would need 2/3 of the world harvest, 4/5 of the world production of meat, massive amount of coal, steel, paper, cars, etc. And then if you add India and the other 3 billion in emerging markets and the West, you don't have to be a Nobel Prize winning physicist or mathematician to figure out this linear growth is just not possible. So the only way to keep that continuous line going up, which investors love when it goes up, they don't like it when it goes down, is basically conflict for resources, war, which investors don't like too long because it's quite disruptive, or massive resource efficiency. And we saw that during one of the better things that came out of the Ukrainian war, energy consumption in the EU dropped by a quarter, 25%. And all of a sudden people found I could wear a sweater and lower the heat and, still survive. So this is the really big driver. Why is there so much interest around that? These are the other drivers. So as I mentioned, emerging markets, resources, resource inefficiency, wealth holders who are trying to integrate philanthropy and investment, the financial crisis, which led to close to it's more like $400 billion in legal fees and fines for the companies doing those CDOs, staff and clients who are looking more and more for purpose, regulation a bit, not that much, stakeholder pressure, students and employee demand on employers and endowments, wealth management, engagement with clients around impact. And most important, which is the really driver as all of these things kick in, and the macro story, business starts to see this is in our interest. And the business case is clear and evident. I love this cartoon that came out after the financial crisis. Turns out poor people with bad credit can't afford to buy a home. Who knew? Or this is really what's very important. If you want to get buy-in, you've got to focus, forget about honor, virtue, justice, fairness, etc. People look at their self-interest, particularly as investors, which is fine. And they have to see what's in it for them. Most important is the money flows. When there's a car accident, a few people gather around and that attracts a bigger crowd and a bigger crowd. That's also the financial system where even when investors are not interested in a subject, if they see money flows going in a certain direction, they take a look, which attracts more money flows, which attracts more money flows, like a car accident. One of the main problems of speeding up sustainability, looking at the environmental and social and governance risk, as well as financial risk, there's no level playing field. Probably the most shocking example is the airline industry. The airline industry, unlike bicycles in Europe are 21 to 25% VAT. Maybe it's a little bit more in Italy, a little bit less. Airlines have no VAT on airline tickets, and there's no tax on kerosene. So they're subsidized to billions and billions, and many of them still lose money. It's an agreement that came out of World War II to try to bring countries together, but it makes no sense if you're going to charge 25 or 21% VAT on a bike and an airline ticket has no VAT. That doesn't make any sense. And that is one of the challenges. Products don't reflect their real cost. So the social and environmental costs are pushed on to society. We have unbelievable amount of greenwashing, which I'll get to in a minute. But at the same time, if we look at how much money is out there, the last Credit Suisse report before they went bankrupt is there's close to 5 times more wealth than there is global GDP. A lot of it is locked up in real estate and maybe illiquid assets, but there's still a tremendous amount of money for, €5 chasing every euro of business. This is the breakdown. If you're really keen, I can share. I think I sent you the PDFs you can share with everyone, the breakdown of the money, the wealth in the world, how it's divided among the world, the pyramid, how much money at the top and then at the bottom. So there's no shortage of money at all. Then everyone seems to be chasing unicorns. But if you actually went to this website of all the unicorns created, hardly any of them are impactful at all. I mean, they generate money, that's fine, but they're not restoring the social and environmental balance, which is what sustainability is about. And when you read their mission statement, it's almost comical. Investment platform focused on generating superior aligned with sustainable principle. What does that mean? We invest to build more inclusive and equitable societies. And you go down the list and the list and the list and the list. And there was a private equity fund out of Denmark called EQT. And EQT has about 35 billion euro in assets under management. And they made an overview of all their investments and how it relates to the UN SDGs, the Sustainable Development Goals. And I thought, wow, that's really interesting. Let me see what it is. So I looked at them and it said, we alleviate poverty. Okay, what do? We invest in a mortgage company in Sweden giving middle-class families mortgages. Or we address climate change by investing in power turbines to do oil and gas exploration. And down the list. And I mean, it's like so ridiculous. But as long as nobody says, I'm sorry, your children are ugly or what you're doing is nonsensical, this goes on. EQT published that on their website. And then when I told the president, they took it down immediately. But one thing they didn't know about, there's a website called Wayback, which allows you to look at every website a year ago, a month ago, 10 years ago, and you could see all of the information. So a lot of these silly mission statements are really meaningless because basically it's about unicorn chasing, almost always. If you look at the liquid assets, they definitely have grown significantly in environmental social governance, looking at investment that provide a market rate return as well as a social and environmental added value based according to the criteria that you're using. And these were the growth in green bonds. They've also gone up really, really high. This is the Green Transition Scoreboard, which over a 11-year period looked at corporate R&D, life system energy efficiency, green construction, water, renewable energy. But was it on the front page of the FT? No. The money flows are definitely going in there, particularly in the illiquid space. I'll get to the reality check about the listed companies. So Bloomberg said ESG assets are going to rise to $50 trillion, and it will reshape $140.5 trillion of global AUMs by 2025, by next year. Really? If there was $50 trillion actually going into restoring the social environmental balance, which is what ESG should be, then we would have no problems with climate change. We would have no problem with deforestation, any of these things, but it's not going in. What it is, ESG, unfortunately, has become a fitness club where everyone wants to show I have a membership card to the fitness club, but I never go. I never get on the exercise machine. It's important to show I'm part of this club, but I don't want to do the work. If we looked at I don't know if you're familiar with the principle for responsible investing. So it's an agreement by many of the leading fund managers and asset owners to manage their money in accordance with more sustainability principles. One of those principles is to vote your shares, vote your stock. And I don't know if you remember, there used to be a Belgian bank called Fortis. Fortis got into trouble because ABN AMRO or they tried to buy ABN AMRO. And in the end, Fortis went bankrupt, along with one of the others was having difficulty. So the share price went from 50 euro to 10 euro during that period of trying to take over ABN. The Dutch government, the Minister of Finance, called APG, which is a big Dutch pension fund, and said it would be good signal to the market if you bought shares now, because they bottomed out. So APG bought 500 million euro in shares of Fortis. The share price went from 10 euro to 90 cents, relatively quickly. So now they had to clean up the mess, and the banking division of Fortis went to ABN AMRO, and they had the shareholder meeting for BNP wanted to take over the asset management arm. So remember, they had this shareholder meeting. APG was there. They had just lost nearly €500 million, and they were an active signatory of the PRI. And the PRI says, vote your shares. All right. So you just lost $500 million. How do you think APG voted at that shareholder meeting? Wrong. They voted to abstain. The worst possible signal to the market is that I understand the politics, but we're going to abstain. So if you're going to vote in that, what is the meaning of the PRI other than an aspirational statement? And then if we look at, there's been tens of billions of euros going into climate tech funds, but none of them are actually going to impact climate in the short term. None of them, zero. None of them publish what is the carbon drawdown of your investments, because they don't draw down carbon. Things like dry air capture, a machine that will suck CO2 out of the air in Switzerland and in Iceland. That's like taking a shot glass to the North Sea, or even Lago Maggiore, and saying you're going to move it one shot glass at a time. It's completely nonsensical, but it will create unicorns. But I keep telling them, please change your name from climate tech funds to unicorn chasers, because it's more clear. But unfortunately, people want to invest in something I think is going to fix. And the same thing with EVs. EVs are not a very effective use of capital. There's massive amount of mining that goes into making that, and most cars are parked 20 to 24 hours a day and only travel 40 kilometers. Public transport on demand is a much wiser investment. So if you're only interested in unicorn chasing, fine, go the climate tech route, go the EV route. But if you're actually looking to address climate, biodiversity is still the best way, but no unicorns, because there is no validated price for biodiversity credits. And one of the few that was doing that was actually supported by Rancilio is Shared X. We have a huge problem of basically getting to address climate and drawing down that temperature, because there's still way too much CO2 emissions being pumped into the atmosphere. So you're going there at some point. You're going to have to do what the Ukrainian war did, is raise prices significantly to reduce consumption, which will be a problem for some people who are not that well, don't have a lot of money. Or you're going to have to ration, because at this stage, at this process, we're not making much progress. And if you just look at the things I listed here, how can you say that there's 50 trillion going into ESG, or responsible investing, or that responsible is working? We have massive climate change destruction. We have unheard of biodiversity loss. We have water shortages happening also now in Europe. We have food shortages. We have health crisis, income inequality, pollution, and threat of war. It's not working. It's not working if that was your goal. But if your goal is, I just want to be part of the membership club, that's all I care about, then it's working. and just keep doing what you're doing. The ones doing the most talk the least. And the ones doing the least talk the most. The best one I remember when around the mid-January every year, second, third week of January, there's a tidal wave of press releases because that's where the World Economic Forum happens. So everybody is putting out press releases of everything we're doing. And Microsoft put out a press release. By 2050, we will have sucked out all the CO2 out of the atmosphere that we ever put into it since we've been in business. Which, that sounds fantastic. How many of you are going to call Microsoft in 2050 say, you missed a couple? And that's why it's a meaningless statement. We need action now, not something that no one is going to check. It sounds good, but it means nothing. So who is benefiting from ESG, environmental, social governance, looking at the environmental impact of the investment, the social impact, the governance, as well as a financial return? The fund managers, they're making their fees. That's their goal. They're, hunters. They're incentivized for short-term behavior. Some are pirates, but in general, they're incentivized for short-term behavior. The institutional investor box tickers, the people that want to show the world, look at, we're as a pension fund, we're part of the club. Aspirational club members, the service providers who are selling the research, advisors, not society or the environment. Because if 50 trillion was really going in there, there would be no need for this conversation. So is incremental, moderate improvement the right strategy? I don't believe so. I think we need a dramatic, radical change, a moonshot, if we want to have a livable planet, not only for ourselves, but also for our children. One of the most important was the Paris Climate Agreement. People forget, it was almost 9 years ago. It was quite a while ago. The positive thing is, perhaps, the Gen Z, the millennials, are going to get close to $40 trillion in succession from their parents. So there's massive transfer of money in the U.S. It's probably a large sum in Europe and Asia. Let's hope that they act in a more mature, responsible manner than we did at their age. But we'll see. We'll see. Most of the wealth holders say, the minute I get that money, I'm switching wealth manager. In general, money is very sticky. People don't leave their private banks as much as they claim they will. The real driver, what I see for the financial sector, which I've been saying for many, many years, is demand for talent. More and more people, Gen Z, millennials, MBA students, they want to work for a company that aligns with their values. They want to follow their big purpose. Dying rich as quickly as possible is not always one of those goals. So attracting the best and brightest will become more and more of a challenge for companies. They're going to have to show more that they stand for. And I'll show you a clip toward the end. I think that these areas of potential investment are the greatest opportunity that we've ever had because they are market rate return and they address the whole issue of social and environmental restoration. Zero emission real estate, new and retrofit. The advantage of real estate, it might be boring, but the minute that a building is retrofitted, whether it's an old one or that a new one built according to high sustainability standards, you see immediately the difference. Investing in stocks, it might go up, might not go up. There's a lot of factors. But with a building, the minute it's done according to certain standards, you'll see immediately the difference. And I'll show you an example. Public transport infrastructure, extremely boring. they have to raise close to $2.2 trillion every year. There are 1,600 public transport members of the UITP, the Union Internationale de Transport Public, and they contacted me and they said, Robert, can you help us with an idea of how we could raise more money? Because their model was they would, Hanover needs 500 million. They'd go to Commerzbank. Commerzbank would cut and paste the bond of the last time, add a few million to the bill, and then go back to the same investors. And I said to them as a joke, when you borrow the money, do you pay it back? I said, yeah, we're AA rated. We're a public-private partnership. So I said, just go to asset owners. You offer them the cheapest, most efficient way to decarbonize their portfolio. You offer yield. There's no technology risk. It's steady cash flow. You have incredibly long track record, and the demand for public transport is constantly increasing. But very rarely will your wealth manager say, you should put in public transport infrastructure. Never discuss that. Fuel-free energy. I don't like the word renewable energy. I prefer why pay for fuel for energy. Carbon sequestering red and blue carbon, so avoided deforestation on land, reforesting, and blue carbon restoring the health of the oceans to sequester carbon. And invest in the two largest employers in the world. I know it's very dull and very boring and not sexy. Small-scale agriculture is the largest employer in the world. It's about 1.3 billion people work in small-scale agriculture. And in hospitality, it's about 330 million. It dwarfs anything in the tech sector. You think that you're going to create 1 billion jobs for the unemployed youth coming up from the global south by teaching them coding and AI? It's not going to happen. But these sectors are big job creators. Water, affordable healthcare, climate resilient cities, and a living wage. There is no shortage of solutions or deals. I often hear from people, Robert, I can't find it. I can't find anything. So I say, where are you looking? Bloomberg. Yeah, if your ghetto is only Bloomberg, you're not going to find very thing. I keep telling you, go in another ghetto, go for a walk, go into other places, network with other people. Just don't hang out with the same ones, because you're not going to find it if that's your goal. But there is no shortage of opportunity that provide a market rate return and also provide a social environmental added value. If you want to do it, if you don't want to do it, that's fine. I like to see ESG and impact. It's not a niche market. It's just a big part. Yeah, we got here early. When you go to a party and you're the first to get there, you say to your partner, oh, this is going to be really boring. There's nobody here. But you have the first mover advantage. You can position yourself next to the drinks, next to the food, and then all of a sudden people start arriving, and it becomes a big party, and you're just there early. We're just early, but we have the first mover advantage. Here are some interesting case studies. This is the largest green retrofit done, the Empire State Building. It was owned by Anthony Milken. He spoke at our conference once, and he was not a fan of sustainability at all, zero. He was just a money guy, which is fine. And he said he did the whole retrofit himself, $525 million. Took all of the windows of the building from the 1930s, added triple glazing, put them back, reduced energy by a lot, reduced water use, CO2 emissions, and then ultimately it was worth a lot more money, and he sold it and made a huge profit on that. The largest SDG real estate project is in Thailand, done by the daughter of the chairman of the CP Group, and 50% new forest, intergenerational, no air conditioning, 40% less in CO2 emissions in an urban setting, climate resilient. Hospitality and food. I probably won't run the whole video of this, but but that was a project that my wife had done in Bhutan, showing in hospitality that you could create opportunities for unemployed youth. She did in Bhutan, was asked to do it in Myanmar and many other places. Second largest employer in the world, was very hard to get investors, did it as a nonprofit. And as I mentioned, agriculture, small scale agriculture, largest employer in the world. But most of the food tech companies are looking, how do we get rid of the farmers? Let's just have robots and drones and, everything automated. And again, it's a unicorn chasing. So next steps, coming to a conclusion, is these are some ideas for investment opportunities: equity funds, second generation engagement, ESG bonds, forest, microfinance, cap and share, green real estate, retrofit funds, many, many. There is no shortage. It's just a question, if you want to, fine. If you don't, fine. And we need to get away from this. That all of these people who invest they love cutting ribbons, but they never want to do the work. They never want to dig the hole, which is the work. The work is doing the work of digging the hole. We need less ribbon cutters. And also, the financial sector are hunters. They're incentivized by short behavior, but we need farmers. And it's hard teaching hunters farming because of that short-term mindset. So, in conclusion, what is your legacy going to be? True story. Did you add gasoline to the forest fire, make a selfie, and enjoy the show? Did you grab a hose, build a fire break, and plant new trees? And did you build a carbon neutral economy and profit immensely? I would love for someone to know, I want all my money to make life miserable for everyone, and I'm working at that 24/7. I've never had anyone ever tell me something like that. It's really, when they realize they can do both, if they want to, they embrace the second. And then what are your business goals? Do you profit, support, and facilitate social environmental destruction, or do you profit, support social and environmental restoration? Simple choice. And to paraphrase Yoda, do or do not. There is no try. And this, I used to teach MBA students. I was trying to get them to use the power they have when a recruiter comes to them to convince them, if you go work for a company, you think you're going to change it from within, forget it, particularly if it's a big company. But when the recruiter comes to visit you, you have power, you have leverage.
Hey, you want to get this job today? Can I give you a little tip? Huh? Let's do it. You're gonna go in. He'll be up here. Okay, you're down here, right? He's on top. He's asking you the questions. Then all of a sudden the interview starts. He asks some questions. You answer some questions. Then you start asking him the questions, and you flip it. Now he's trying to impress you. Turn that shit around on him. Turn it around on him. Topsy-turvy, that motherfucker. Yeah.
So even Larry David at Curb Your Enthusiasm realized that the power is with the individual. They can change companies by refusing to work for them. And we need far fewer. If you're not in the polar bear business, don't use these photos when explaining your company. It has nothing to do with polar bears. So my time is up. I hope that you found this worthwhile. I'm happy to take any questions that you might have.
Thank you so much. Thank you, Robert. This was super insightful. And as mentioned in my intro, there is, so much confusion. And then you mentioned greenwashing around ESG themes. So I'm keen to ask you a few questions before opening it up to the listeners. But obviously, measuring and verifying some of the claims that, these sustainable companies or investment is very hard. What methodologies do you recommend for ensuring accurate and reliable ESG reporting? And does everything need to be measured?
Well, I'll tell you an interesting story. It won't take long. Every time that we did the TBLI conference, I would invite all of the different leading measurement systems to come present. And every single time I invited them, they all refused to present together. They said, put me in a different panel. I don't want to be with my competitors because they never wanted comparability. So last year we launched the Better World Prize, which is basically we invited hundreds of various ESG measurement systems, put a panel together. It was going to be a People's Choice Award. People would vote, not a jury. And we gave them clear instructions, and they had 5 minutes to present why is their system the best. So we got 44 independent research providers. Some of them are brilliant, like Bonnie Lorraine Smith, which she talks about materiality, not materiality. Another one is Matt Moscardi, who only looks at the board of directors. But what was the most interesting is 100% of all of the well-funded ones, PRI, Carbon Disclosure Project, B Corp, MSCI, Sustainalytics, World Benchmark Alliance, EcoVadis, all of them refuse to present. All. Because they don't want comparability. You know, when you go buy shoes, you'd want to try different shoes on to see how it looks, how it feels. And that's the same way with deciding you're in the coffee business or you're in the luxury textile business. I don't know the business that person is in. I'm in a very specific business. What would work best for me? You know, the GRI, the Global Reporting Initiative, which also refused to present, they created this very, very long list of KPIs. And one of the most important one is diversity. Sounds good. Okay, I'm a listed Finnish company in the north of Finland. There's only white Finns working here. There are no Italians, there's no blacks, there's no Chinese. We're in the, and I have to look at diversity. Oh, I score very badly on diversity. So you have to really look at your situation. And I don't think it's one size fits all. If anybody is interested in looking at the various methodologies, they're on our website. You can just go to tbligroup.com and you see Better World Prize. And all of the presentations are there, except the ones that refuse to present. And what's funny, EcoVadis used to beg me. He was having tough time financially. He said, "Can you waive the €200 fee to attend your conference?" So I said, all right. And then he got €750 million investment. 750 million for a data provider in supply chain. Okay, the business is big, but why is it that you're afraid to present that? Because they have a lot to lose. And unfortunately, I think that Luca would probably like Matt Moscardi's approach of looking at only the board. That's all they do. They don't look at anything else. They just look at the behavior of the board. So I can't say which is the best one. I like a lot of Bonnie Lorraine Smith's approach that companies should be in service of life, which is a very noble thing, but also a high bar. So I can't say this one is better than that, but I think you have to look at where you are and where you want to be. At the moment, there are no angels. A lot of heroes, but no angels.
Thank you, Robert. And actually, can you provide some examples of how ESG investments have matched or outperformed traditional investments in terms of financial returns? Because obviously, Rancilio Cube is an investor. There's a lot of listeners who are investing, and making money is obviously important, and doing, but with having a positive impact, also as well. So, what metrics do you use to compare the performance outcomes?
Well, I mean, basically, you could do all of the things fantastically and fail. Examples: Swiss Air. Remember Swiss Air? They went bankrupt, and they were the leading sustainable airline company. Digital. I don't know if you remember, maybe you're quite young, but Digital Equipment was an IT company, computer. Also, leading sustainability went bankrupt. Body Shop won all these awards for the best sustainable reporting, had to be taken over by another cosmetic company. So reporting everything is not a guarantee of success. However, I remember all of the mainstream financial guys would always say, these alpha males would say that ESG is not good enough, not good management, not good deals, not good reporting, blah 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 blah. But they would also say the most outrageous lies that all hedge funds get 30% return. I'm sure Luca is laughing at that now. All private equity funds always get 30-40% returns. And every fund manager in liquid assets always beats the benchmark. So those nonsensical claims of the so-called mainstream are never confronted clearly. And when we started, people from the pension fund would say, Robert, this is interesting. Do you have research that shows there's no underperformance at worst or an outperformance at best? And I stupidly used to send all the research because there was loads of research. And then I finally had the aha moment and realized that this was not about proof. This was about belief. And I looked up how much research was done on subprime collateralized debt obligation, which caused the financial catastrophe. I'm sure some obscure university somewhere in Canada wrote a paper, but nobody read it, and how much money went into everything. So that's when I stopped sending the research. There's no guarantee that if you look at all of the environmental social governance rules, that you will automatically outperform if it's a service or a product that nobody wants. WeWork was supposedly what everybody wanted, supposedly, according to Adam Neumann, and didn't prosper. But it is a guarantee that if you don't do it, it will affect you in many other ways in your ability to borrow money. Now there's EU requirements for companies under, I think, above 500, that they have to report according to certain standards, that personnel want to work for a company. But basically, when you think about it, if you're a very ESG focused or sustainable company, it means you're wasting less energy. You're using less energy. You're using less raw materials. You're producing much less waste. You have fewer fines. You spend less money on HR in attracting the best and the brightest and keeping them. All of those things together generate more profit for your company ultimately. So that's really the issue. But choosing the right one based only on sustainability, that's, like saying, Warren Buffett, I think, told his wife, when I die, only invest in index funds because they're the only ones that actually beat the market on a regular basis. So no guarantee, but pretty much a guarantee if you don't follow. Like, there is a strategy of investing in the worst companies and doing very well. So it's called second generation engagement. So you choose in the SMEs, you choose the worst companies, the dogs, the really horrible companies that are listed. And you do activist hedge funds. So instead of putting a gun to your head, raise your share price or we'll kill you, you put a gun to their head. You say, get rid of the toxic companies, improve the environmental governance, improve your social governance, or we'll kill you. And because you're investing in the worst of class, theoretically, you will raise the share price quicker than investing in the best of class and trying to chat with them. We tried to help a fund getting off the ground doing that. I still believe that you can actually achieve sustainability goals quickly and have a higher return as a strategy. This is in listed companies, but I think most of the investment on Rentierly Cube are in the private equity space or debt space, not so much in listed. But we need to be critical of what everyone claims, whether it's an ESG or impact, or traditional fund managers who always say we're always getting 30% return, 35, 40.
Thank you, Robert. I'm now going to open the questions to the audience because we've received quite a few and we only have a few minutes, like 10 minutes left. Luca is asking, Europe established rules for ESG, but doesn't seem really to operate as a sole country. Is the US doing better without strict rules? For example, an electric car, vegan meat, etc. Is free market a secret sauce for sustainability?
Yeah, well, we just actually did a masterclass on that with the most successful shareholder engagement company. They're the only company that was invited to Washington to testify before the House, along with CalPERS, CalSTRS, BlackRock, all the big players. And they want to ban ESG completely. It's not going to happen, but they want to ban that. America, I mean, I grew up in America. It's a country of children. So they love toys. And it's great for innovation, constant innovation. And yes, it's more of a free market in certain ways. In other ways, it's quite communist in their approach, rather unusual. But the new guidelines that's coming in for ESG in Europe will also probably be adopted in Asia, because a lot of time has been spent in that. USA is just a very, very big investment market, and they don't like, regulation. ESG is often very light because it's more, again, being part of the club. I don't think it's US is very good if you're looking for lots and lots of great innovation. The downside is that they burn through companies also very quickly. And we saw that with during COVID, when all of these online events companies came about. The one that we had was funded by Will Smith and Andreessen Horowitz, and they pulled the plug very quickly also. So they're not also long-term backers, and then families understand more long-term. I say that there, yes, you have innovation there, but I don't really believe that a lot of the innovation is something that's really beneficial to society. And lots of startups, but you just have to look at a show like Shark Tank and think, who the hell will buy this crap? And oh wow, it's great. We have this great company. So I think that actually Europe is taking a lead on that. You might really enjoy that masterclass we did on this new ES regulation. But Asia will probably look more to what's happening in Europe than it will to the US.
Our next question comes from Diego Dainesi. What should an Italian fund with an ESG compliant investment policy do to differentiate itself from a universe of funds that claim to be impact oriented but are actually engaging mostly in greenwashing?
It's if you're talking about fundraising, which is probably what you mean, how do I raise more money when a lot of these funds are just garbage? That's my frustration too. A lot of the funds that claim, I guess yours is an Article 8 or Article 9 fund, they're not really doing very much. But most of the LPs or GPs tend to gravitate toward fund managers that have brand names or been around a long time, mainly because they have to report to someone else. And most of our work is raising money for a lot of these funds. Some are incredible track record, but it's very, very frustrating, and it's farming. It's not hunting. It takes a very long time. And since post-COVID, everyone is busy just being busy and not getting anything done. So you've got to filter, follow up, and constantly chase because people don't respond. I had one of the most successful seventh generation family office in France. He calls me and he says, Robert, I can't talk Thursday. I'm interested in the fund. Can we talk Friday? So I wrote back, sure. And I asked, what time? And he never responded. And every day for 6 weeks, I kept responding, what time? So it's not only the convincing, it's getting through. And there's no magic bullet. We've actually added AI to our process of raising money. It made it more effective. But there's no magic bullet. And unfortunately, although there is a big diff happening among the Dutch pension funds, for the first time, the Dutch pension fund, APG, has decided that we made a big mistake with engagement with Hermes. Doing that for 15 years was a complete waste of money. We're stopping. They allocated 30 billion euro to investing in true impact, and they're doing as small deals as 6 million. 6 million for a pension fund with 600 billion is unheard of. But they realize we need to fund the next energy transition, and it's not going to be all with TPG and that. So there are some changes happening. There are others. The world is not only EIF, and you just need to, push that a lot, and you have to kiss a lot of frogs before you find your prince. There's no magic.
Our next question comes from Andrea Cipriano, who's asking, can you share some success stories or impactful projects that have emerged from TBLI's network of social impact investors?
Yeah, lots. We had one, maybe not in your sector. They were a large microfinance investor, and they asked us to introduce them to a Japanese bank, Daiwa. And I made an introduction. They were in Japan. We organized a conference. We put them on the same panel. And Daiwa gave them a mandate of 250 million euro, which is pretty big. And it was quite unfortunate because I didn't make an agreement about, an upside or anything. So I asked them, okay, could you write a testimonial? Oh, no, we can't do that. Compliance, blah, blah. I said, how about sponsoring our cocktail party for, a couple thousand? Oh, no, we don't have any money for that. So that was a pretty big one. We had fund of funds we've raised money for. We had a industrial holding that we got them a 5 million investment from a wealthy Asian investor. We've done biodiversity projects. We'll probably close on a very boring company in the egg production business called Kipster. We tend to focus more on illiquid assets, private equity, real estate, things like less in liquid assets. What we're good at is filtering out the noise because we don't manage money. I never said, oh, Luca, you should do impact investing. By the way, give it to me to do it for you. That already creates a lack of trust. So people know they can complain that, he's such a pain in the neck, Rubinstein, about constantly pushing for impact, but he's authentic. Maybe it's not for me, but I trust him. So we've had, a large number of things. Forest project that the Church of Sweden, we got APG. Another pension fund put in 75 million in a what is it called? It's a essential commodity that's used in Coca-Cola, and the guy I know was launching a fair trade. So we got them to agree to 75 million. It really depends. We turned down quite a few funds that actually don't make a difference. Like we'll get requests. I'm an Article 9 fund in France. Okay, what do you do? Oh, we build police stations. Okay, that's fine, and I'm sure police stations are needed, but is that really restoring the social and environmental balance for us? I like biodiversity a lot. I like food very much, healthcare. We've traditional Chinese medicine in capsule form. We've done a lot of different things, and we're just kind of selective with whom we work with. I can send you more information if it's relevant.
There's a final question from Nicola Lorini. In light of recent market outflows from ESG products, what strategies do you think are essential to reinvigorate interest and confidence in ESG investing in times of geopolitical tensions and international trade complexities? I
think what ESG should be, my definition, might not, our definition is when, while you're making money, are you restoring the social and environmental balance? Under that definition, nobody gets into the club. It's like the soup Nazi from Seinfeld. No soup for you. So I think that a lot of people have difficulty with the present methodology. I was in Singapore, and a very big family office said, Robert, could you stop by? So I opened the door and I have nearly a heart attack because their business was coal trading, oil trading, gas trading. And the family wanted to get away from all of that. They said to me, Robert, we don't understand. We look at the ESG indexes and we look at the best companies, and most of them are quite toxic. Like, BP and Shell score very high, but their business is carbon factories. I look at Unilever, what do they make? Processed food and semi-toxic cosmetics. They don't really make anything that makes you healthy. And so, because the methodology until now was not what you did, it's how you reported. So ESG was always about risk, and impact is more about output. What are you actually doing and producing? So until some kind of idiot-proof system that people feel comfortable. But it's the same thing with climate tech. Climate tech sounds like you're fixing climate. That's why I'm investing in there. But none of them publish what are your carbon drawdown. And when I confront them with that, you're not fixing climate. You're chasing unicorns, which is okay. If your goal is and 10x return, that's fine. Just say so. But don't pretend that you're partly pregnant.
Thank you so much, Robert. That was a really great session. I hope for everybody listening, they understood a little bit more about ESG, and thank you for answering all of our listeners' questions. If you want the slides that Robert, you said we could share them, right?
Yeah, please do. One final comment. I just there was a big Dutch foundation that had 500 million in assets, and the CEO said, "I want to start doing ESG and impact. I'm going to make mistakes. I'm not going to do it well." So I said, "Yeah, sure, okay." So he asked his wealth manager, "How about starting with index funds on ETFs?" So the wealth manager said, no, if we do that, you're going to lose money, bad idea. So the CEO said, okay, I'll go find a wealth manager that can. And all of a sudden that wealth manager said, no, I can do it. And he kept doing a little more each year. So about 5-6 years later, he calls me up. He says, Robert, it's really not that hard to do sustainable investing if you want to do it. It's just really hard to do if you don't want to do it. And that's, do it or don't. Just stop chatting about it.
A great, a great point to leave this conversation on. So thank you so much again, Robert. And
thank you for inviting me and for organizing.